The US budget deficit is out of control. But does it actually matter? And if it does, why hasn't it had more impact on the US economy and the financial market? Can it be because of financial engineering by the Biden administration? Who bought $3 trillion worth of US Treasury securities over the past year? And can they keep it up? How will the upcoming US election shape the outlook for the deficit in the years to come? Is it too late for the US economy to grow out of it? The Congressional Budget Office raised its forecast of the 2024 U.S. budget deficit this week. It now sees the deficit hitting $1.92 trillion in 2024, up from $1.69 trillion in 2023. Adjusted to exclude the effects of shifts in the timing of certain payments, the deficit will amount to $2 trillion in 2024. And that is 7% of GDP. 7% of GDP will be the highest deficit ever recorded in peacetime, outside the COVID pandemic and the Great Recession periods. At 7%, the US budget deficit will also be one of the highest in the world. In terms of primary deficit, which excludes interest payments, the US will be in the company of Turkey in 2024. Only China and Japan will run a bigger primary deficit. Fiscal health is usually a reflection of general economic health. The great irony about the ballooning US budget deficit is that the US economy could not be doing much better, both in absolute and in relative terms. The US economy grew 2.5% last year, the fastest among large developed economies. US GDP is now 10% bigger than before the pandemic. Only a handful of countries in the world can boast of such performance. Thanks to a strong labor market, surging stock market, and climbing corporate profits, personal income tax receipts are up 35% and corporate income tax receipts are up 104% compared to the pre-pandemic period. Indeed, total federal government receipts over the past 12 months are about 35% higher than in 2019. Incredibly, this will not stop the US budget deficit from doubling from $1 trillion in 2019 to $2 trillion in 2024. If the strong US economic performance of the past 3 years could not slow down America's runaway fiscal train, what would prevent the crash ahead? Since 2019, federal expenditures have increased by 43% compared to the 35% growth in federal receipts. Medicare, Medicaid, Social Security, veteran benefits, and defense make up 70% of all federal spending. Over the past 5 years, these expenditures have increased by 40%. And they're unlikely to slow anytime soon, given Americans are getting older, living longer, and war drums are beating ever louder. What's more, regardless of which party wins the election in November, we can count on both parties to not want to touch these highly politically sensitive expenditures. Entitlement reform is long overdue, but the only way it will get done is if both the Republicans and the Democrats agree to take the credit and the blame. Given the extreme polarization in the country, there is little chance of that happening soon. The question of how to deal with the deficit is likely to feature prominently in the upcoming presidential debate on June 27th. On this issue, the main difference between Biden and Trump is what they plan to do about the 2017 Trump tax cuts that are set to expire at the end of 2025. Trump has hinted that he will make his 2017 tax cuts permanent. According to the Congressional Budget Office, This will add an additional $3.3 trillion to the national debt. Biden vows to end the Trump tax breaks for income above $400,000. On top of that, he's proposing to raise the corporate tax rate from 21% to 28%, impose a 25% minimum income tax on billionaires, increase the marginal tax rate on the highest income from 37% to 39.6%, and boost taxes on capital gains for high earners. It is reasonable to assume America's budget deficit will be bigger under Trump than under Biden. Fiscal policy will be more expansionary under Trump than under Biden, which means both growth and inflation will be higher under Trump. This means bond yields were very likely to be higher under Trump than under Biden. Higher bond yields mean higher interest payments on America's debt. With debt to GDP ratio currently near 130%, a difference of 100 basis points in average borrowing costs will result in a difference in annual interest payments of 1.3 percentage point of GDP. Republicans will no doubt argue that lower taxes will allow the U.S. to grow out of its debt trap. But what happened over the past 3 years makes this a hollow argument. With the unemployment rate at 4%, spending on mandatory programs growing faster than GDP, and debt to GDP ratio over 100%, if there's one thing we can be sure of, is that there is no fiscal free lunch. Economics 101 tells us the high level of government borrowing will crowd out private investment and slow down economic growth. So far, this has not happened in the US. Why not? To understand why, we need to go inside the US government bond market. Over the past 2 years, the market has had to absorb both a high level of Treasury issuance as well as unwinding of the Treasury holdings by the Federal Reserve. The combined net supply of bonds by the US Treasury and the Federal Reserve has been averaging close to $3 trillion annualized rate over the past 4 quarters. $3 trillion are a lot of Treasury securities. Who's been buying them? Who's got the deep pockets? Money market funds have bought a lot of Treasury securities over the past 4 quarters. Indeed, $1.5 trillion worth of them, nearly half of the total net supply. But it's important to note that more than 90% of these purchases were short-term Treasury bills. Over the past 2 quarters, US banks have been adding to their holdings of Treasury securities. This is consistent with a slowdown in their lending activities. However, after the collapse of Silicon Valley Bank and others in 2022, US banks have discovered interest rate risk. And I think it's safe to assume that these days they're sticking to shorter duration bonds. US households bought a lot of bonds in 2022, but lately their buying has slowed. Indeed, they even turned net sellers in the first quarter as the equity market made new highs. The bond culture is less developed than the equity culture in the US. In my view, retail investors are unlikely to become a major source of demand for US government bonds, especially with an inverted yield curve. What about foreigners? Foreigners sold US Treasuries in 2022, but have been buying since the beginning of 2023. Despite net sales by China, foreigners bought $600 billion worth of Treasury securities over the past year, and most of these purchases were not bills. Foreigners are attracted to the US Treasury's safe haven status, deep liquidity, and the high real yields that they currently offer. Except for foreign demand, overall demand for US government bonds is at best lukewarm. So how did the US find buyers for $3 trillion worth of these Treasury securities over the past year? The answer is simple: financial engineering. The US Treasury massively reduced the duration of its net issuance. Indeed, it replaced bonds with bills. It issued only $539 billion worth of bonds over the past 4 quarters, which almost exactly matched the foreign buying of bonds. In other words, the US government only sold bills to Americans. It's pretty incredible sleight of hands, financial black magic. But this is why long-term US bond yields are not much higher. This is also why the Fed hikes to date have not resulted in a tightening of US financial conditions. This is why we have not seen any crowding out of private investment by the huge US government deficit. But this is clearly not sustainable, unless the US plans to become like Turkey to depend mostly on short-term bills to finance its government debt. The Biden administration is doing everything in its power to help Biden get reelected. It is trying to cap oil price by not enforcing the sanctions on Iranian oil exports. It is trying to cap long-term interest rates by financing the massive deficit with Treasury bills. Are you so surprised that the US stock market is having the best year for a US election year in 50 years? I'm not.